In this video, we are going to consider a problem on retirement of partner. Let's see the problem. Here they have given you that Vaishali, Madhuri and Manasi are partners sharing profits and losses in the ratio 3:3:3. Means they are sharing profits and losses equally. So each partner's share is 1/3. Vaishali retired on 1st April 19 from the firm. So let's see the old balance sheet first. At the liability side, you would find creditors, bank overdraft, general reserve, and capital account balances. Asset side, you would find cash, debtors, RDD, furniture, machinery, motor car, and profit and loss account balance. This is accumulated loss, which will be transferred to partner's capital account debit side. Whenever the profit and loss account is given at the liability side, we transfer it to capital account credit side. Here also we are going to transfer the capital account balances and general reserve to capital account credit side. So let's see this. In the partner's capital account credit side, you would find the opening balances by balance brought down. Vaishali 28,700, Madhuri 31,800, Manasi 30,000. Total general reserve of rupees 12,000 is distributed among the three partners in equal ratio 4,000, 4,000 and 4,000. Similarly, the profit and loss account balance which was given at the asset side is transferred to partner's capital debit side. Each one of the partner would get 1,500 as they are sharing the losses equally. Then let's see the adjustments. First, furniture to be valued at 14,000, machinery 38,000 and motor car 23,800. Here they have given you values of assets after revaluation. Whenever such values of assets or liabilities are given after revaluation, then we write these values in the outer column. So these values we are going to write in the outer column 14,000, 38,000 and 23,800. Whatever values are given for these assets in the old balance sheet, those would be transferred to inner column as usual. So furniture 15,000, machinery 40,000 and motor car 25,000. These values would be transferred to the new balance sheet inner column 15,000, 40,000 and 25,000. Then whatever is the increase or decrease in the value of asset, that we show here as depreciation or appreciation as the case may be. Whenever the amount written in the outer column is less than the amount written in the inner column, then the difference will be termed as depreciation. And when this amount in the outer column is greater than the amount written in the inner column, then the difference would be termed as appreciation. In this problem, all the three assets are getting reduced, the value is getting reduced, so the difference will be termed as depreciation, and this depreciation we are going to show here in profit and loss account debit side. Furniture 1,000, machinery 2,000 and motor car 1,200. Then the next adjustment is RDD should be maintained at 5% on debtors. Debtors are 16,000. 5% on 16,000 is 800 rupees. So they want RDD to be maintained at rupees 800. Originally in the old balance sheet, RDD is given at 2,000 rupees. That means you have to reduce this RDD by 1,200 rupees. So let's see the effects. Here the liability is getting reduced, so we are going to show it at profit and loss account adjustment account credit side by RDD 1,200, that is the difference between 2,000 minus 800. 800 is the new RDD that they want in the new balance sheet. So in the new balance sheet, you are going to show debtors inner column 16,000 less RDD. This is 800 instead of 2,000. Outer column it would be 15,200. Next adjustment, goodwill of the firm should be valued at 15,000 rupees. However, only Vaishali's share in it should be raised in the books. Vaishali's share is 1/3, so goodwill's her share in goodwill will be 15,000 into 1/3, that is rupees 5,000. First effect, partner's capital account credit side, we are going to write it as by goodwill account. In Vaishali's column only, we are going to write the amount rupees 5,000. And second effect, as this goodwill is raised but not written off, it will be reflected in the new balance sheet. So in the new balance sheet asset side, we are going to show goodwill rupees 5,000. After that, this is the last adjustment, saying part payment of 10,000 should be made to Vaishali and balance should be transferred to her loan account. So when you close this account and when you find out the balance payable to the retiring partner, that is Vaishali, out of that total balance, 10,000 should be paid out of the cash and the remaining balance will be transferred to her loan account. So first let's understand how to calculate this amount payable to Vaishali. For that, we are going to take her capital account credit total, which is 28,700 plus 4,000 plus 5,000, which is 37,700, minus her debit total, which would be 1,500 plus 1,000, that is 2,500. So difference between these two total will be 35,200. Out of this, 10,000 would be paid in cash. So the remaining amount would be 35,200 minus 10,000, that is 25,200, which will be transferred to her loan account. So these entries would be shown at the debit side of partner's capital account as to cash. Only in Vaishali's column we are going to write 10,000, and to Vaishali's loan account, again in Vaishali's column, 25,200. After this, Vaishali's capital account will be closed and we are not going to show any closing balance for Vaishali after this. Then for the remaining two partners, Madhuri and Manasi, we are going to close their capital account and find out the closing balance, for which we would follow the similar process. Here we are going to take the credit total for Madhuri's capital account. From that we are going to reduce the debit total. So 35,800 minus 2,500, the balance is 33,300 for Madhuri. For Manasi, the credit total is 34,000. From that we are going to reduce debit total, which is again 2,500. So the balance is 31,500. So here we are going to write it as two balance carried down, the closing balance for the continuing partners. Now from the partners capital account, we are going to transfer this loan amount and the closing balances of remaining partners to new balance sheet liability side. Here we are going to write it as Vaishali's loan account 25,200. This amount we are going to show over here. And capital account for Madhuri and Manasi 33,300 and 31,500. Also, we have to give effect of this 10,000 being paid to Vaishali in our cash balance. Previously, here if we see in the old balance sheet, the cash balance was 19,500. Now, in the new balance sheet, from this 19,500, we are going to reduce this 10,000 and your new cash balance would be 9,500. Now after doing all these adjustments, we are going to check our old balance sheet and we will find out if there are any assets or liabilities which are unaffected by all these adjustments. If we see, there are two liabilities, creditors and bank overdraft, which are not affected by these adjustments. So we are going to write these liabilities as it is in our new balance sheet. So creditors, outer column 10,500 and bank overdraft, outer column 5,000. So after doing all these things, your balance sheet will tally at 1,05,500.